If you're trying to decide between ETFs and mutual funds, you're not alone. This is one of the most common questions new investors ask. Both are excellent ways to diversify your portfolio and invest in hundreds or thousands of stocks with a single purchase. But they work very differently. Here's what makes this decision tricky. Financial advisors, robo-advisors, and investment platforms all have different preferences, often based on what makes them the most money, rather than what's best for you. The result is a lot of confusing and conflicting advice. Today, I'm breaking down the real differences between ETFs and mutual funds, who each one is best for, and exactly how to decide which option fits your investing style and goals. By the end of this video, you'll know definitively which choice is right for your situation. Hit that subscribe button because I'm cutting through investment confusion every week to help you make smarter money decisions. What are ETFs and mutual funds? Both ETFs, exchange-traded funds, and mutual funds pool money from thousands of investors to buy diversified portfolios of stocks, bonds, or other investments. When you buy shares, you're getting a slice of that entire portfolio. Think of them like investment baskets. An S&P 500 ETF and an S&P 500 mutual fund both own the same 500 companies in the same proportions. The difference isn't what they own. It's how you buy and sell them, how they're managed, and what they cost. The key insight is that both achieve the same goal of instant diversification, but through different structures that create distinct advantages and disadvantages for different types of investors. How they trade. The biggest difference. The most fundamental difference is how you buy and sell them. ETFs trade on stock exchanges like individual stocks throughout the trading day. You can buy or sell ETF shares anytime the market is open, and the price fluctuates minute by minute based on supply and demand. Mutual funds work completely differently. You can only buy or sell mutual fund shares once per day after the market closes, and everyone pays the same price regardless of when during the day they place their order. This price is calculated after markets close based on the net asset value of all holdings. This trading difference creates several practical implications. With ETFs, you can use limit orders, stop-loss orders, and other trading strategies. With mutual funds, you're stuck with whatever price is calculated at day's end. For most long-term investors, this difference doesn't matter much, since you're buying and holding for years. But if you want flexibility or are making larger purchases, ETF trading advantages can be significant. Cost comparison, where the money goes. ETFs generally have lower expense ratios than mutual funds, and this difference compounds significantly over time. The average ETF charges 0.18% annually, while the average mutual fund charges 0.54%. On a $10,000 investment, that's $18 versus $54 per year. Not huge initially, but over 30 years, that difference could cost you over $30,000 in lost returns due to compound growth. However, this comparison isn't entirely fair because it includes actively managed mutual funds. Passively managed index mutual funds often have expense ratios comparable to ETFs, sometimes even lower. The real cost advantage of ETFs comes from their structure. ETFs use an in-kind redemption process that allows them to shed low-basis shares without generating taxable events, making them more tax-efficient than mutual funds. Mutual funds sometimes distribute capital gains to shareholders even when they haven't sold their shares, creating unexpected tax bills. ETFs rarely generate these unwanted taxable distributions. This is where mutual funds often win for beginners. Many mutual funds allow you to start investing with as little as $1, and you can invest exact dollar amounts. Want to invest $347? No problem with mutual funds. ETFs trade like stocks, so you can only buy whole shares, though many brokers now offer fractional shares. If an ETF costs $150 per share and you have $200 to invest, you can traditionally only buy one share, leaving $50 uninvested. Mutual funds also make automatic investing easier. You can set up automatic monthly investments of any dollar amount, making it simple to dollar cost average into your investments. Many ETFs now offer fractional share investing through major brokers, but mutual funds still have the edge for small, regular investments and exact dollar amount investing. Active versus passive management. Most ETFs are passively managed, meaning they track an index like the S&P 500 without trying to beat the market. Most mutual funds are actively managed, with fund managers trying to outperform benchmarks through stock selection and market timing. This creates a fundamental philosophical difference. ETFs embrace the idea that markets are efficient and beating them consistently is nearly impossible. Mutual funds bet that skilled managers can add value through active decision-making. The evidence strongly favors passive investing. Over 15-year periods, more than 90% of actively managed mutual funds fail to beat their benchmark indexes after accounting for fees. Yet, active funds charge significantly higher fees for this underperformance. However, some excellent passively managed mutual funds exist, and some ETFs are actively managed. The key is understanding what you're buying and whether you're paying for active management that historically doesn't deliver superior results. Tax efficiency, a hidden advantage. ETFs are generally more tax efficient than mutual funds due to their unique structure. When mutual fund investors redeem shares, the fund might need to sell holdings to raise cash, potentially generating capital gains that get distributed to all shareholders. ETFs handle redemptions through an in-kind process with authorized participants, avoiding most capital gains distributions. This means you only pay taxes when you sell your ETF shares, not when other investors sell theirs. For taxable accounts, this tax efficiency can significantly impact long-term returns. If you're investing in tax-advantaged accounts like 401ks or IRAs, this advantage disappears since you're not paying taxes on growth anyway. Which is better for different investors? Choose ETFs if you want maximum flexibility in trading and order types, prioritize low expense ratios and tax efficiency, prefer passive index investing, are comfortable with share-based investing, have larger amounts to invest at once. Choose mutual funds if you want to invest small, exact dollar amounts regularly, prefer the simplicity of automatic investing, don't mind paying slightly higher fees for convenience, are investing primarily in tax-advantaged accounts, want access to specific active management strategies. For most beginners, mutual funds might be easier to start with due to lower minimums and simpler automatic investing. As your portfolio grows and you become more sophisticated, ETFs often become more attractive. For tax-efficient investing in taxable accounts, ETFs usually win due to their superior tax characteristics. For retirement accounts, the choice matters less since taxes aren't an immediate concern, so focus on fees and convenience. The hybrid approach. You don't have to choose exclusively. Many successful investors use both ETFs and mutual funds strategically. You might use mutual funds for automatic monthly investing in your 401k, while using ETFs for tax-efficient investing in taxable accounts. Some investors start with mutual funds for simplicity, then transition to ETFs as they become more knowledgeable and their account balances grow. Practical recommendations. For most investors, low-cost index funds, so on. whether ETFs or mutual funds will outperform expensive active funds over time. Focus more on keeping costs low and staying diversified than on the specific structure. If you're just starting out with small monthly investments, mutual funds from companies like Vanguard, Fidelity, or Schwab offer excellent low-cost options with easy automatic investing. If you have larger lump sums to invest or prioritize tax efficiency, ETFs often provide better long-term value through lower costs and superior tax characteristics. Avoid high-fee active funds unless you have compelling reasons to believe specific managers can consistently beat the market. History suggests this is unlikely. The ETF versus mutual fund debate often gets more attention than it deserves. Both can be excellent investment vehicles when you choose low-cost, diversified options aligned with your investing style and goals. The most important decisions are starting to invest consistently, maintaining appropriate diversification, keeping costs low, and staying invested through market volatility. Whether you achieve this through ETFs or mutual funds matters far less than actually doing it. Don't let analysis paralysis prevent you from starting your investment journey. Choose the option that feels more comfortable and matches your situation. Then focus on the habits that actually build long-term wealth. Which investment structure appeals more to you based on your current situation? Let me know in the comments, and if this comparison helped clarify the ETF versus mutual fund decision, hit that like button and subscribe for more practical investing guidance. Remember, the best investment strategy is the one you'll stick with consistently over decades of market ups and downs.